In this module, we are going to discuss some of the basic topics behind payroll accounting. So specifically, we're going to talk about some of the FICA taxes, the income taxes, and unemployment taxes. So as a quick overview, we're going to talk about various taxes, both the employee side, which means that this is withheld from an employee's paycheck, and the employer side, which means that the employer themselves has to pay these taxes, and it is not something withheld from the employee's paycheck. So in general, anytime a company wants to expand a bit, when you start off as a one-person company, a sole proprietorship, expanding generally means that you're going to have to hire employees, and as soon as you hire even your first employee, then you have to deal with all these various taxes, withholdings, and we're going to talk about both the liability and expense side of things in this module. So we're going to talk about how to record those expenses and how to record the liabilities to set them up. So this also brings in the topic or the concepts of gross pay versus net pay. Now, simply speaking, gross pay is if you're talking about a salaried individual, let's say they make $2,000 per month. The gross pay would be $2,000. But anybody that's ever had a job where you work for a paycheck, if your salary was $2,000 per month, you know that you're not taking $2,000 home. The net pay is the amount you actually get to keep and spend. The difference between the two is the fact that you have all these withholdings, you have all these taxes that you have to pay, and they're withheld rather than you having to pay the full lump sum at the end of the year. The taxes are withheld from your paycheck along the way so that you owe the difference, or maybe even you'll get a refund. So we'll talk about some of those things during this discussion. The first type of withholding I want to talk about, the first two types, Social Security and Medicare. So these all fall under what is known as FICA, the Federal Insurance Contributions Act. This is something that's been around since the 1930s, and Social Security has been around since the 1930s as well. That's what gave rise to this act. Now, the concept behind the FICA, this Federal Insurance Contributions Act, is that employers are responsible for withholding these payments, these taxes, so to speak, from the employer's or the employee's paycheck to ensure that the money is paid. So this is something for Social Security and Medicare. You're never going to have to complete some sort of tax return and pay an additional amount in. This is handled completely throughout the year. So now, generally speaking, when you're taking an accounting course, they're not going to require you, again, for the most part, to memorize these percentages. Generally, these percentages don't change, or they certainly haven't for quite some time, with the exception of the Social Security withholding. For a couple of years there, a while back, this was decreased by 2%, so it was down to 4.2%. Now it's a 6.2% tax. And the important thing to note here is that this is a capped amount based on a certain level that changes every year. It increases from year to year. For example, for 2016, the cap was $118,500, and for 2017, this was increased to $127,200. What that means is for this year, 2017, if you make $140,000 of income, you're not going to be taxed on that remaining $13,000 for Social Security purposes. Now, of course, you'll still have all the other taxes, income tax and such, but you will not be charged that 6.2% Social Security tax. Now, Medicare is a little bit different. Medicare is taxed at a 1.45% rate, and it has no limit to it. So whether you're making $50,000 a year, $700,000 a year, you're still going to be taxed 1.45%. Now, just a quick overview without going into too much detail. Social Security is a program to cover the retirement for the elderly as well as disability income. Medicare is intended to cover the health care side of that, again, for retired individuals as well as disabled individuals. So that is the FICA. These are what are known as the FICA taxes. Again, that FICA covers both Social Security as well as Medicare. Now we'll move on to the concept or the topic of federal income taxes. Now, any individual that earns income in the United States is responsible to fill out a tax return, file a tax return, and pay a particular amount of federal income tax depending on their pay, their withholdings, and what tax bracket they happen to fall in. The important thing to note with the federal income tax is that we have what is known as a progressive income tax. Now what that means is the rates get higher as you earn more money. So, for example, currently the brackets are set that $0 through $9,325 per year, they're taxed at a 10% rate. Now, it's progressive, which means that as soon as you make $1 over $93.25, that last dollar is then going to be taxed at the next bracket, 15%. Your first $9,000 is still taxed at 10%, but the additional amount is taxed at the higher rate, 15%. So, for example, this year, the next $28,000 approximately is going to be charged at a 15% rate, and then after that next bracket, the next $53,950 is going to be taxed at a higher 25% tax rate. Now, the important thing to understand with the taxable income, without going into too much depth because this is not a tax class per se, the tax you pay, the taxable income, is not going to be the same as your total income that you earned. There are certain deductions. There you have a personal exemption, either standardized or itemized deductions that reduce your total income down to an amount known as taxable income. That taxable income is what is going to be multiplied by these percentages. Now, the amount that's actually withheld from a paycheck is determined based on the number of exemptions, the number of dependents, your marital status as filed on the W-4 form to your employer. That gives them a way of estimating how much tax they think you will owe, so that hopefully by the end of the period, by the end of the year, what you've paid in is close to what you will ultimately owe, so you don't owe an excessive amount at the end of the period, and you really don't want to be getting too big of a return, because what that means is that you've lost out on the potential to use that income throughout the period. So that's the federal income tax. Again, we'll see a journal entry in just a little bit, but this is basically a withholding. It's an estimated withholding. State and local income taxes are very, very similar. The big difference is that the employer, they're not going to pay the IRS for state and local income taxes. They're going to pay your state taxing authority. The rates can vary by state, and they many times do. Not all states have state income tax, or certainly not all localities, not all cities have a local income tax. Some do. It's the same basic concept as the federal taxes. It's just a different entity that you're paying to. Some other employee, I'm loosely using the word taxes here. They're basically withholdings. These are voluntary type deductions. They're not really a tax to any agency, any government. These are things like your health insurance, your retirement, your gym membership, charities. These are things that you request that your employer withhold on your behalf, and they pay to that particular entity, whatever that company is. So the key thing, the reason they're in this module, is that they are a withholding. So they're paid to the proper payee, and they're not paid to you, so you don't have to worry about cutting a check to that other entity. So what we have here is an example of a journal entry, assuming that the gross pay for all of these employees, and we'll see later in the next couple of entries that we're assuming for this particular month, let's say, we have 10 employees that are making $10,000. That's just the assumption we have here to make this a nice round calculation. So we have the $10,000 per month for these employees, for 10 employees, totaling $100,000. This is considered the gross pay, and it's going to be a debit to salaries expense to increase it. Now, on the credit side, we have all of our various payables. These are basically representing the fact that we owe money. As an employer, we owe money to all of these entities. The two FICA payables, and you'll notice the percentages here, 6.2%, 1.45%. And by the way, the 6.2%, I am essentially assuming that none of these employees has made over our cap, our $127,200, or in this case, $118,500. Now, we have the percentages. We also have federal income tax payable, state income tax payable, health insurance payable, retirement payable, and finally the salaries payable. This is the amount that is going to go to the employee themselves. This is the amount that's referred to as the net pay. Now, the next topic we have here is related to the employer side deductions. So the first thing to note is that even though the employer is withholding a certain amount for the two FICA taxes, the Social Security and the Medicare, not only do they have to pay that amount to the government, generally the IRS, all of that goes through the IRS, they also have to match it. So if they withheld $1,000 from your paycheck, they would also chip in an extra $1,000, and the $2,000 would be paid in total to the government. So that's a new, or I should say, an additional tax for the employer. But we also have two different taxes that are only employer side. They don't relate to anything on the employee side. Here we have the Federal Unemployment Tax Act, known as FUTA. We also have the State Unemployment Tax Act, known as SUTA. Again, these percentages don't have to be memorized, but what you need to know, currently the percentage for the federal tax is 6.2% of the first $7,000 of a worker's wages. Again, this is the amount owed by the employer themselves, the company, not the employee. Now, that federal tax, if your state had no state tax, then you would be paying a full 6.2% to the federal government. But if your state happens to have an unemployment tax of their own, they could have that tax rate all the way up to 5.4%, and that amount would be credited against your federal 6.2%. So what that would essentially mean is that if your state tax was 5.4%, your federal tax would only be 0.08%, or 0.8%, I'm sorry. So finally, let's take a look at the journal entry for the employer side taxes. Now notice the debit that we used here is different. It's not salaries expense anymore. It's often referred to as payroll tax expense. Now the $11,990 is simply the sum of all of our credits. So the credits are going to be our two FICAs, Social Security and Medicare. Notice these will match the amount from our last entry. Then we have FUTA tax payable. Remember I said we have 10 employees? So we took the 10 employees, multiplied by the $7,000, multiplied by the 0.008, which is 0.8%. That's going to be the FUTA tax, and the reason for that is that this particular state has a 5.4% rate. So again, we take the 10 employees, multiplied by the 7,000, multiplied by 0.054, which is 5.4%. That's where we get the $3,780 for the SUTA tax payable. Those are examples of journal entries that you'll see when dealing with payroll taxes. There is certainly more depth you can go into with this topic, but this should give you enough to get through most of your basic accounting courses.